All right, guys, in this video, we're going to talk about estate tax strategies, right? Ways to get around this estate tax. Now, this probably doesn't apply to you guys right now, but it could apply as you have other people older than you, right? Grandparents or parents that maybe are passing on assets. So this could be relevant. And also, I just find it really interesting and think you guys probably will too. So it's just kind of a way to understand how the really wealthy use all these different loopholes and strategies to avoid paying extra tax on their money. Now, this is not an exhaustive list, but these are some of the primary ways that can be used. So we're just going to hit these really quick. So gifting, I'll also add that there are a lot of restrictions around this. The IRS is well aware that people want to avoid paying this tax. And so people are very creative and come up with a lot of ways to try and get around paying it. And the IRS has shut down a lot of those ways. Okay. So they have sealed up a lot of loopholes and things like that, but there are still some ways to do it. Tax legislation that has been proposed further looks to reduce some of these loopholes. All of these things are subject to change. And if this is your situation or your parents or grandparents or something like that, then they really need to be working with qualified attorneys and tax people to make sure that they do this effectively. Okay, so gifting is the first strategy. You can gift money. Anybody can gift anybody money up to $15,000 a year with no tax consequences. Okay. So let's say that I'm old and wealthy and I want to start passing money on to my kids. I can give each one $15,000 each year. The recipient of the gift owes no tax. It's not income. You just get the money. The giver pays no tax. I don't pay any tax. If I go above 15,000 in any given year, then that amount starts counting towards or against, I should say, my lifetime exemption of transferring money, right? Which is $12,060,000. So if I just decide one year to give $115,000 to one of my children, $100,000 of that is going to count against that lifetime exemption amount. So if I do this every year and I'm giving several thousand, or I give $1 million away a year for 20 years, well, I've already hit my exemption of money I can pass on without being taxed, and I'm going to be taxed on the rest. Okay. So up to $15,000 a year you can do with zero consequences. If you do above 15,000, then you file a tax form and it's, included against that exemption amount. Now, that could be $15,000 per year per individual. So I could give $15,000 and my wife could give $15,000 to that individual, and we're good. Technically we could give $30,000 between the two of us to one person, and we're good. If one of my children, let's say they grow up, they get married, we could give $15,000 each to our child, $15,000 each to their spouse. So effectively giving them $60,000 while not getting into tracking how much is going against that lifetime giving exemption amount. Anything above $15,000, you file a form and they track it. So one thing to think about, again, if you have other people older than you, parents, grandparents, that are starting to transfer money, these are things to keep in mind, okay? Direct payments is another method. So if you think about maybe your parents or your grandparents want to contribute to your college education, and so they might add money to a 529 or go pay. Well, all of that also, if it's above the limit, the $15,000 limit per year, it can also count towards that exemption amount. The difference is if you do direct payments, it doesn't. So if somebody goes to college and it costs $80,000 a year in tuition, if somebody makes that payment directly to the university for $80,000, it is not considered a gift to the person. Okay, so you can actually cover all their college costs without it counting against your lifetime giving exemption. Same thing for medical bills. Let's say there's tens of thousands of dollars in medical bills. If they pay directly to the medical facility or whoever is charging that bill, instead of getting it to the person to then pay it, they also get out of paying or having that amount count against their lifetime giving exemption. So you got to do direct payments, education or medical purposes. Okay. Low interest loans is another one that can be done. So you can loan money. If you loan money interest free, it is considered a gift. Okay. And they will count that. So you have to structure it in a certain way where there's at least a minimum amount of interest rate charged so that it's a legit loan, but it can still be preferable to other interest rates. This is based on the applicable federal rate, the AFR, that is adjusted from time to time as interest rates change, right? They're constantly changing. And depending on the term of the loan. So in April 2022, as of the day of this video, short-term loans are considered from 1 month to 3 years, and that is charged a 1.26% interest rate. Midterm loans go from 3 years to 9 years, and it's a 1.87% interest rate. Long-term is anything above 9 years, and that is a 2.25% interest rate. Interest rates just were recently increased. Okay, so if you look before this, those rates are actually much lower. But since interest rates just increased for everybody, the AFR was affected and it increased as well. Okay, I've seen this work really effectively for somebody. Instead of going to take out student loans or instead of going to get a mortgage, they're able to, somebody that's wealthy can just lend them the money at a very low interest rate. So instead of paying 6% on a student loan, they could pay 1 or 2%, okay, on that student loan. So they're still getting a big benefit as far as interest is concerned, and it's giving them an advantage. Same with a mortgage, right? Instead of getting a 4% mortgage, they could get 2.25% mortgage. So low interest loans are a way to do it. This is actually commonly done when we think of creating generational wealth. Somebody needs a business loan, right, to start up. It can be hard, as we've talked about. It can be hard to go get a small business loan to start a business. It can be a little bit easier to go get a small business loan to purchase a business, right? All of those require money, though, and collateral, and it just depends on the risk. So if you want to start a business or go buy a business, this is a way you can borrow money, right? A wealthy person, they can lend you the money. It's not against their, it doesn't count against their state tax exemption, and they can lend it at very favorable rates to give you a leg up, and you can take this money and go, do your venture, buy the business, start the business, whatever, while paying a preferred interest rate. Okay, so that's commonly done. And then the last couple are some trusts. There are 2 trusts here. There are a lot of other trusts involved. There's just a ton out there. So I'm not going to go into details on all of those. You can create very complicated structures for all of this. But here are 2 common ones. Okay, the first one is a grantor retained annuity trust. This is an irrevocable trust. If you remember what we talked about, irrevocable means once you grant it, it is gone. It is no longer your property. You have given it away, and it is a permanent thing. You can unwind it, but there are serious ramifications for that. Sometimes you can't unwind it. Other times you can, but there can be penalties, a whole lot of other things that come along with it. So irrevocable means it is done. It's done. It's gone. It no longer belongs to you. So what you might do is, let's say that you have a bunch of assets and you want to grant them now. Let's say you've got $5 million. And by the time you die, that could be, based on how it grows, right? You invest it and it's going to grow. Maybe that 5 million turns to $25 million. Well, if you pass on $25 million, then you are going to owe a ton in estate taxes. Whereas if you give it now, it's only $5 million and it just goes towards your exemption amount. Okay. So what you do is you grant the 5 million now into the GRAT, the grantor retained annuity trust, and you invest the money however you want, right? There's beneficiaries listed on this trust. They are ultimately going to receive it once the grantor is dead. So you grant 5 million in, and what happens is you receive a little annuity. So like you receive annual income based on, they have a number of different calculations for that, but essentially based on the amount that's in there and how much it's earning and all that stuff, they send you an annuity to the grantor. So the grantor receives an income and is taxed on that income. They'll receive that until they die. Okay, so it's not like you give away assets and have nothing to live on. You can actually live on that asset in the form of an annuity from the trust. That can be your income while you've given a huge chunk of money away. So that's why it's grantor a retained annuity, right? You're retaining this annuity stream, this income stream from it for a certain amount that's calculated, but the actual amount you granted is gone, okay? No longer yours. So with the assets in there, or the trust corpus is what it's called, the principal amount that you've granted, that will grow, right? You can invest it, whatever it can grow. Let's say it grows to 25 million. When you die, your annuity stops, right? You stop receiving income. Sometimes if you have a spouse, then they can continue to receive that income. And it's only once both of you have passed that this happens. But it just depends how it's written up. The annuity stops. and all 25 million can go to the beneficiaries, but it's largely free of tax. It's a way to bypass the majority of the tax there. Okay. So it can grow if you have a small amount, it can grow into exceeding that lifetime exemption amount, like that 12 million that we talked about, and you can still pass it on to your beneficiaries without the estate tax. Okay. This is one of those trusts that is being heavily scrutinized in legislation, and they're looking to get rid of grantor trusts for this reason. But that's how that one works. Okay. And then the last one we'll talk about is an irrevocable life insurance trust. Like I mentioned, the death benefit is tax-free to beneficiaries of a life insurance contract. Death benefit is tax-free, but the total amount, let's say it's $2 million, that amount is included in the calculation for your gross estate. And if you go above the exemption amount, then it will be taxed. So it's a contributing factor to your total assets that you're passing on. So to get around that, there's this irrevocable life insurance trust. Again, irrevocable means you don't reverse it. Once it's done, it's done. Okay. And what happens is you set up a life insurance policy on your own life, and you set it for a lot. I don't know, $5, $10 million, whatever. Okay. Whatever amount you can get or that you decide on. So you can set that up. The beneficiaries can be, for example, your children. The owner of the life insurance policy is this irrevocable life insurance trust, this ILIT, I-L-I-T. This trust owns the insurance policy, and you pay the premiums. So you're paying the premiums. The trust owns the contract for the life insurance. So they own the contract, and the beneficiaries are listed in the trust and in the life insurance contract as like your kids, for example. Okay. So what would happen is you're paying on these premiums, right? So you're putting money into this trust to pay the premiums. And then when you die, the whole insurance, the death benefit is paid out to the beneficiaries, but it's not included in your gross estate because it was an irrevocable trust. Irrevocable and grantor and all that stuff basically means you're taking assets and you're putting them outside of your estate, what's calculated as your estate. So this insurance benefit, let's say it's $10 million death benefit, that can be passed on and it's tax-free, right? The death benefit's tax-free, but that amount is also excluded from your gross estate calculation. So it does not factor into how much assets you're transferring on to beneficiaries, and therefore how much is exempted and how much is taxed, okay? So another way that's commonly used to pass on money to the next generation and avoiding the estate tax. So anyways, those are some really interesting strategies that you can use. Again, always subject to change based on legislation. And there are a lot of other ways you can do it that are very complicated, but we're not going to go into those in this course. All right, that wraps up this video. We'll move on to the next.
Timing matters more than people realize.